Welcome to the deep dive. You're looking at the markets, trying to figure out which stocks have real potential without spending hours crunching numbers, right?
Right.
We've got a rapid fire approach for you today. A seven-step framework to analyze a stock in, well, roughly 30 seconds.
Yeah, think of it as a first filter, a really efficient one.
To spot those key opportunities quickly.
Exactly. We're diving into a pretty neat tip that really boils stock analysis down. Our mission, to unpack these 7 steps.
And look at the thinking behind them, yeah.
Precisely. And show you how they can, quickly give you a surprisingly sharp perspective on whether a company is even worth digging into deeper for your portfolio.
Okay, sounds good. Each step hits a different angle, right? Company health, future potential.
That's the idea. Okay, so first up, industry relative revenue growth.
Step one, what's the key thing we're looking for here?
Well, this step asks a simple question.
hmm
Has the company's revenue growth over the last 3 years, say, beaten its industry average?
Okay, why that comparison?
The logic is, well, if a company is growing faster than its direct competitors, it's likely taking market share, snapping it up.
Which is usually a good sign.
A very positive sign, generally. Suggests momentum, maybe a stronger offering, or better execution. It points towards future potential.
Right, so if a company's lagging behind its industry peers in growth, that's kind of a quick no in this framework, a red flag.
That's how this system flags it, yeah. It labels them below average growth. The thinking is, look, market leaders tend to show that superior growth.
So it prioritizes the winners.
Exactly. Now, are there exceptions? Sure. But for a quick screen, this step focuses you on companies already demonstrating they can outpace the pack.
Makes sense. Okay, step two. We're looking at the price to earnings ratio, the PE, but relative to the industry.
That's right. The check here is the company's PE ratio below the average for its specific industry?
And the idea there is potential undervaluation, a bargain.
Potentially, yes. A lower PE compared to direct competitors might mean the stock's cheaper relative to its earnings. It could be an opportunity to buy into that sector at a better price point.
And that industry comparison is crucial, isn't it? Because PEs vary so much between sectors.
Hugely important. You absolutely can't just look at a PE in a vacuum. Tech companies often have much higher PEs than, say, utility companies. It's just the nature of those businesses.
Different growth expectations, different risk profile.
Exactly. So comparing within the industry levels that playing field gives you a much more meaningful benchmark for valuation.
And if it's higher than the industry average,
Then this framework flags it.
Right.
Relatively overvalued. Suggests you might be paying a premium compared to its peers, at least based on current earnings.
Okay, clear. Moving on to step three, the price to earnings growth ratio, or PEG. How does this add to the picture?
So the PEG ratio brings growth into the valuation equation. The question here is the PEG below 1.5?
Mm-hmm.
Or if it's a big market leader, is it maybe okay if it's below 2?
Okay. So generally under 1.5 is good value for the growth you expect.
That's the general rule of thumb, yeah. It suggests the price isn't too far ahead of the expected earnings growth.
Yeah.
You're not overpaying for future potential, ideally.
But you mentioned a slightly higher tolerance, up to 2 for market leaders, like the Apples or Teslas of the world.
Right. There's a bit of nuance there. The idea is that these dominant established companies, maybe with really strong moats, they often command a premium.
Investors pay a bit more for perceived safety or reliability.
Exactly. You might accept a slightly higher PEG for that lower perceived risk and maybe more predictable growth.
Mm-hmm.
So the PEG is really about balancing price and growth.
Trying to avoid situations where the growth story just doesn't justify the stock price.
Precisely. If it doesn't meet the criteria, it gets tagged growth too expensive.
Got it. Step 4 takes us to efficiency. Return on invested capital, ROIC. What are we looking for here?
Here we're looking at the average ROIC over the past 5 years. And the target in this quick check is it above 8%?
Okay, 8%. What does that tell us?
It's a measure of how well the company is using all its capital, so both debt and equity, to actually generate profits. A consistently high ROIC above that 8% suggests efficient operations. Good management.
It's a sign of a profitable, well-run business.
The strong indicator, yes.
And why ROIC specifically? People often talk about return on equity, ROE.
Yeah, good point. ROIC is often seen as a more complete measure. ROE only looks at shareholder equity, but ROIC. It includes the debt financing, too.
So it captures the return on the total pool of capital the company has deployed.
Exactly. It gives you a clearer, more holistic view of capital efficiency. If a company is consistently below that 8% mark, this framework flags it as inefficient capital use. might be a warning sign.
Okay. Step 5 feels important. Financial health check. Debt to equity and quick ratios. Two parts here.
Yep, a double check on financial stability. First is the debt to equity ratio below 1.
Meaning less debt than equity financing the company, lower risk.
Generally, yes. It suggests the company isn't overly leveraged, which can be risky, especially if interest rates rise or business slows down.
And the second part, the quick ratio.
The quick ratio needs to be above 1.2. This measures the company's ability to cover its immediate short-term liabilities using its most liquid assets. Things it can convert to cash quickly. It excludes inventory, which can sometimes be hard to sell fast.
So it's a tougher test of immediate liquidity than, say, the current ratio.
It is, yeah. Gives you a better sense of whether they can handle their bills right now.
So putting these two together, manageable long-term debt and sufficient short-term cash, gives a decent picture of financial resilience.
That's the goal. A pretty solid snapshot of financial risk. If a company fails either of these checks, the flag is financial risk, potential balance sheet weakness.
All right, step 6 moves into something a bit less quantitative. Sustainable competitive advantage. How do we assess this quickly?
Yeah, this one requires a bit more judgment, a bit more qualitative thinking. You're looking for what protects the company from competitors long term. Its moat.
Like what? What are examples?
Well, think about a super strong brand, like Coca-Cola maybe, where people consistently choose it. Or patents, really important in pharma or tech.
Network effects. Like social media platforms.
Absolutely, where the service gets better as more people use it. Or just being the dominant market leader, maybe having huge economies of scale that smaller players can't match. Think NVIDIA, perhaps, in certain GPU areas.
So it's about finding something durable, something that competitors can't easily copy or overcome.
Exactly. That's the key sustainable. It's what allows a company, hopefully, to keep growing and stay profitable over the long haul, even as competition tries to chip away.
And if that moat seems weak or non-existent,
then the label is lacks durability. It suggests the company's future might be a bit more vulnerable to competitive pressures.
Okay, makes sense. And the final step, number 7, alignment with market trends, checking the bigger picture.
Precisely. Zooming out, is the company operating in a sector that's currently getting a boost from major trends? Think about the overall market environment.
Like for 2025, you mentioned AI, clean energy, healthcare innovation, things like that.
Yeah, those are great examples. Is there a major technological shift, like AI, that's lifting boats in that industry? Or a societal push, like towards clean energy? Or demographic trends favoring healthcare?
So the idea is that a rising tide lifts all boats, or at least helps.
It certainly can. Investing in a sector that has strong tailwinds that's attracting investor interest can increase your odds. Even a really solid company can struggle if its whole industry is out of favor or declining.
Right. A great company in a terrible industry might still be a tough investment.
It can be, yeah. So if the company sector doesn't seem to be benefiting from any strong positive trends, this framework flags it as unfavorable sector.
Okay. So after all that, if a company passes all 7 checks, revenue growth, relative PE, PEG, ROIC, the financial checks, the moat, and favorable trends, then what?
Then, according to this rapid screening method, the signal is invest.
Meaning it looks promising on this initial pass.
Exactly. It suggests, based on these specific metrics and factors, that the company shows a potentially attractive mix of growth, value, efficiency, stability, competitive strength, and operates in a sector with momentum.
Wow. Okay. So to quickly recap the 7. 1. Faster revenue growth than industry peers. 2. PE below industry average. 3. PEG generally below 1.5, maybe 2 for leaders. 4. ROIC consistently above 8%. 5. Debt to equity below 1 and quick ratio above 1.2. 6. A clear, sustainable competitive advantage. 7. Writing favorable market trends.
That's the checklist. A pretty demanding but fast initial screen.
It really forces you to look at multiple angles quickly.
It does. But, and this is really important, it is just a starting point, a filter.
Not the final word.
Absolutely not. Passing all 7 is a great sign. Suggests it's worth putting on your research list.
Yeah.
But it doesn't replace deeper due diligence. You'd still want to, really dig into the financials, understand the management, the competition, the risks.
Get the full story. But as a way to rapidly sift through possibilities, it seems pretty powerful.
It can definitely help you focus your research efforts on companies that, at least initially, seem to tick a lot of the right boxes.
Definitely. So thinking about these 7 factors, it really makes you consider what maybe overlooked industries or companies might actually be lining up well against these criteria right now? Something to mull over.
Yeah, applying the framework can sometimes surface interesting ideas you hadn't considered.
Great stuff. Thanks for walking us through that framework. A very insightful deep dive.